Hello, welcome everyone to Rethinking Capitalism, week 3. Hope you're enjoying the course so far. We certainly are, finding it very exciting. This week's lecture is on land, housing and economic rent. And I'm Josh Ryan Collins, as you should know by now, course coordinator, and I'm also doing the academic lecture today. And I'm delighted to be joined by Toby Lloyd down here, who is actually advising the government on housing and has a distinguished career in housing policy, encompassing both private sector, used to work for a housing consultancy, public sector. Also worked with Ken Livingstone when he was Mayor of London. And he's also done a lot of very interesting work in a personal capacity and in paid capacity, trying to develop new types of housing ownership models, including community land trusts and cooperative housing models. So he's really well equipped to provide the policy context. And he will be speaking at 4 o'clock. Just a couple of quick announcements about the course itself. The readings for weeks 4 and 5 and course unit descriptions are now up on Moodle, so no excuses for not doing your readings. Please have a look. I will be posting the exam questions later this week as well. The coursework questions later this week. The other point is, anybody has bought a copy of the textbook Rethinking Capitalism but not yet paid, please can you give the money to Simone, who's down here, if you've got the money today. Okay, I will commence. As I said, talking about land, housing and economic rent. The format of today's talk will be as follows. I'll first talk a little bit about the housing crisis, the housing affordability crisis that we're facing in this country, as those of you who are living in London will know all too well, but it's also a broader problem. I'll then talk about land and this concept of economic rent and how that's explained in economic theory. I'm then going to talk a little bit about the relationship between land and finance, which is a key kind of missing dynamic from much of the mainstream policy and economics literature. Then talk briefly about the relationship with inequality, and of course we have a lecture on inequality coming up in February, given by Branko Milanovic, and then conclude, and then Toby will talk about some of the policy implementation challenges of trying to address some of these problems. The talk today will be largely based on a book written by myself and Toby called Rethinking the Economics of Land and Housing. It's on the left-hand side. Two of the chapters are on the Moodle, but I do encourage you to purchase it. A very good book, because actually the whole book's quite relevant to the topic, and it's also some of the chapters will be useful for other parts of the course, particularly around inequality and as a critique of sort of mainstream economics. It's a useful book. And the other book is a book by myself, which was published in October last year, which focuses on the relationship between housing and finance. So, without further ado, what is the problem? Well, this chart shows house price to income ratios, which is generally the best way of thinking about affordability, because of course, house prices can go up, but if people's wages increase and incomes go up, then it doesn't really matter so much because you can afford to buy a more expensive house. But it's the relationship between the two that's most important. And this shows the house price to income ratio averaged across 16 advanced economies, including all the big players, UK, US, European countries, etc., since 1980 up to the present day. And it's averaged against the long-run average for the OECD economies, which is a broader range of of countries. And that's that dotted line, the 100 is indexed against 100, the dotted line on the screen. Now what you can see here is there's some evidence of a sort of housing or a cycle, housing affordability cycle you might call it, around that long run average, up until the sort of early 2000s, when, as you can see, from about sort of mid-2000 onwards, it goes above that average, and then it doesn't sort of come back down for a very long time. It doesn't come down, in fact, until the global financial crisis of 2007, 2008, the most serious crisis in advanced economies since the Great Recession. So a key part of that crisis was this very rapid rise in house prices beyond their so-called fundamentals or sort of equilibrium state, which again you can think of perhaps as this dotted line. So that's the sort of most immediate fact to think about. But of course what's almost even more interesting is that post-crisis, rather than that ratio coming back down to its long-run average, as it did in this previous kind of spike here in the late 80s, it stays elevated well above that long-run average. And we don't get that return that most economists were expecting. We don't get that return. Instead, house price, or the affordability ratio sort of takes off again from about 2013 and reaches a peak actually higher than it reached in 2008 on average across all of these countries. Obviously, big differences, as we'll see, between different countries. So another interesting fact. So how do the key question is, how do you explain these kinds of dynamics? What about the UK? Well, if we superimpose the UK on that graph, you can see that housing affordability, the ratio of house prices to income, is much more cyclical in the UK than it is on average across advanced economies. We tend to have bigger bubbles and bigger busts, very, very severe busts, very rapid drops in house prices, and just a highly cyclical, highly volatile picture there. So very hard to kind of, if you're a home buyer or you're an investor, you're buying into an asset which is extremely volatile. Although if you bought in the mid-1990s and sold in 2007, you'll be incredibly rich. I don't know how many of your parents managed to do that, but anyway, that's the nature of the market, highly cyclical. And as you can see with the UK, we also rebounded in 2013, and things have slowed down recently. I think that's probably almost certainly Brexit related. Anyway, that's the UK picture. But the UK is not alone in experiencing this elevation in that house price to income ratio since the early 2000s. The same pattern can be seen in many advanced economies, and particular in the Anglo-Saxon economies, the English-speaking economies, Australia, US, Canada, New Zealand are mapped here, and this shows the home ownership rate as a percentage of all households in these countries. And what you can see there is this very interesting picture of rises in that level up to the early 2000s, with the exception of New Zealand, where home ownership levels reached well above 70% much earlier. But then a synchronized fall in the levels of home ownership since the financial crisis, certainly, and even starting before that in some countries. So Anglo-Saxon capitalism is modeled on this concept of the home-owning democracy. The idea that you can, if you work hard, if you're entrepreneurial, if you're, you can have a stake in society by buying a place of your own, a house of your own. That was a key promise of Margaret Thatcher's Conservative administration, and in fact it was a policy or a political ideology that was also embraced by the Labour Party many years before that. But it's not working. It's clearly not working. That sort of dream of the home-owning democracy this chart shows you no longer applies, and not just in the UK, but in many countries. So the average level home ownership rate has essentially fallen from around 70% in the early 2000s to closer to 65% now in most Anglo-Saxon countries. So how to explain this? Well, in the press, in the news, you'll be aware there's lots of explanations. One of them is that there's too many people on our crowded island, too many immigrants in particular. They tend to get the brunt of the attacks from politicians like Dominic Raab, who, by the way, used to be Brexit minister, didn't last very long there. But when he was housing minister, that was his sort of one of his central arguments. It's the immigrants what done it. But there's a more general story about Britain's population growing too fast, and that's the cause of rising house prices, obviously more people. And that, of course, the other aspect of that is the idea that not enough homes are being built to house all these new people. So on both the left and the right, you see this call for more housing. The Labour Party, the left-wing parties tend to say we need more affordable housing, whereas the Conservative Party is still very focused, until quite recently, on the idea that everyone should be able to own a home. So you need to build more homes so that everyone can own a home. Slightly changed recently, and Toby can probably talk about that a bit more. Another criticism is, well, one of the reasons we don't build enough homes is that the planning rules are too restrictive, too bureaucratic. They don't allow enough home building fast enough, and thus we are destined to have these rising house prices. So those are some of the most popular explanations that you typically will see in the newspapers. But I would argue that none of them actually explain the patterns we've seen in the previous graphs. So just looking back at this graph, where we see, let's even skip the UK, let's just look at this average. Do we think any of those explanations, increase in population, excessively strict planning rules, not building enough homes, help us explain this very, very rapid rise in the house price to income ratio from the early 2000s? I don't think they do, because I don't think in all of these European countries you suddenly had a fall in the rate of building new homes or a sudden massive expansion in population. It's just not the case that happened. Immigration did increase a little bit perhaps, but not on a scale to really help us explain this dynamic. and also doesn't really help us explain this sort of rebound from 2015 onwards. Something else is going on. There's an elephant in the room. In fact, I would sort of say there's two elephants in the room, and they're interacting in an interesting way. So what I'm going to talk about really is what are those elephants. The first one is land, and the way in which land, as opposed to housing, has not been properly understood and conceptualized in economic theory and in policy. Now, so what do we mean by land? What we mean in an economic sense is land as space, physical space through time. Okay, when we say land, it's often thought of as sort of soil or earth or some sort of physical, something with physical properties that can enable you to do things. What we're really talking about is space. Land did used to be primarily used for growing food to feed ourselves. Then it became increasingly used for industrial production. In the Industrial Revolution, it was the site of factories, railways to transport stuff around. Actually, now, today, the economically most important use of land is domestic property, is housing. And if you look at any of Thomas Piketty's work, he shows quite clearly that the main value of land is for property, housing. Land is essential for all economic activity. That should be obvious. You can't actually have a factory, you can't have workers to work in a place unless you've got somewhere physical for them to live or to operate the factory. Even virtual companies, platform companies, Google and Amazon have huge, generators in the desert. You need physical space for economic activity. But the key thing about land is it has quite unique economic properties that distinguish it from the other two main factors in the production process, those being labour and capital. And I'll talk about that more in due course. How does land present itself in capitalist economies? Its key form, legal constitutional form, is landed private property. The idea that this sort of space is given over for use by this particular individual, and no other individual can interfere. Crossing the boundary, you are invading uninvited, you are invading private property, you can be prosecuted. Now, of course, it's slightly more complicated than that. Some of you may be very lucky and own houses, or you may have parents who own houses, and they may own a flat inside a block, and that block is actually owned by someone other than the individual. So it's owned by the freeholder. So you may have a leasehold and a freehold relationship, and the leasehold typically, is 90, 100 years in this country. Then it literally runs out, and that property returns to the freeholder unless it's renewed. So there are different forms of ownership. You can also have cooperative ownership. You can also have public ownership of land. But the key institution is landed private property, and this is a real building block of modern capitalism. The idea is unless you have private property, it becomes much harder for markets to work efficiently, for people to be able to exchange with each other. Another key thing about land is if you look at the historical, the political and economic history, the ownership of land is largely determined by politics, by relationships of power. War is particularly important in explaining why certain bits of land are owned by certain people or institutions. It's not actually driven by economic dynamics so much. And this is a major problem if you're trying to develop an economic theory of land without referring to political science and political developments. But from an economic perspective, another really important thing about land is that it can have multiple economic uses at the same time. Okay, the most obvious use of land today, as I said, is as a consumption good, providing shelter, providing housing, providing a place to live so you can get to work, providing a place to live so you can bring up your kids. That's obviously, you consume that on a day-to-day basis. But land can also be a very useful financial asset, a store of value for wealth, for savings. It tends to hold its value very well. And it's also a very important source of collateral, security, if you want to get a loan from a bank. Now, the final point, which this lecture will focus on in particular, is that ownership of land or property enables you to gain a return that's not necessarily an economic return, that's not actually necessarily related to your efforts and skills. And this is called economic rent. So that's some sort of big picture, what are the key properties of land. Going back to our previous challenge, how do you explain house prices? Well, one of the key ways you help explain them is you look at what's actually been happening to land values rather than house prices. And what you can see here is land, real, adjusted for inflation, land and house prices in the UK indexed against 1945. So 100 is 1945. And what you can see here is the house prices have gone up in the UK about five, this is up to 2008, about 5 times, but land prices have actually increased 15 times compared to 1945. And what you can also see, of course, is the land price index is much more volatile than the house price index. You have much bigger booms, bigger busts, and evidence here also that the increase in land values comes before the increase in house prices. And empirical evidence supports this idea that actually land prices are the key constituent in driving house prices. There's some research that shows around 81% of all increases in house prices since the 1950s can be explained by increases land values. So land is key in explaining that housing affordability challenge. Back to this problem of rent. Now, economic rent, this idea that if you own some land, if you own a property, you can essentially gain a return from the fact that around you other people are building roads, increasing the fertility of crops, or investing, which means your location where your property is based becomes more desirable, becomes more economically desirable. It's quicker to get to somebody builds a new school, really good school, everyone wants to live there and put their kids there. Some great new railway station opens up, meaning you can get into the centre of London 5 times faster. The area suddenly becomes much more attractive. You happen to own a property. The value of your house goes up. You can sell it. You can realise that value by selling your house. It's nothing at all to do with your own efforts, right? You've just happened to buy that property before this development occurred. This problem, which is very apparent today in London, was seen by the founders of classical economics, political economy as it's known then, as absolutely central problem of capitalism. This is Adam Smith. As soon as the land of any country has all become private property, the landlords, like all other men, love to reap where they never sowed, with no effort, and demand a rent even for its natural produce. And in fact, Smith was not alone here. David Ricardo was the key theorist of economic rent, focusing on agricultural land, but it was an analysis also shared by John Stuart Mill, by Marx, by Proudhon, socialist, anarchist economic thinkers, that this rent problem was absolutely fundamental. The problem would be that as owners of the land raised the rent that they charged, investors, businesses, and households would have to pay more and more to the landowner to live in the most desirable places and have less and less available for investment to create new services and to spend money, consume stuff, which keeps the economy moving around. These scholars agreed on this primary problem, but they had disagreements on how to deal with it. So the British economists, Ricardo, Smith, and Mill, felt that taxation was the key policy tool for addressing the rent problem, that landowners should essentially be taxed on all of those rents that they could extract from other people's effort. Marx and Proudhon argued that land should be nationalised, socialised, so you socialise those economic rents. Today, of course, things are slightly more complicated because when these classical thinkers were writing, you did kind of have a very identifiable group of landowners, typically the people who literally owned the agricultural land, the kings, or the landowners. I mean, they literally were huge landowners, and everyone else sort of had nothing. Today it's a bit more complex because today actually we do have quite widespread home ownership. It's 65% in the UK and most Anglo-Saxon countries. So actually middle-class ordinary voters are also enjoying rent extraction vis-a-vis those renters who have to pay rent to them. So it's a bit more, policy-wise, perhaps that makes things a bit more complicated. Toby can probably elaborate on that point. This is Winston Churchill also complaining about economic rents. And I won't spend too much time on this because it's essentially saying the same thing as Smith, but a couple of hundred years later in the Houses of Parliament. Now, what went wrong? How did economics end up losing this analysis of rent as the sort of key challenge facing capitalist systems? Well, you had the emergence of what's called neoclassical growth theory, and you have this idea, as I've already explained, of private market exchange and private property rights being presented as naturally occurring things. John Locke, for those philosophers in the audience, John Locke's theory was if you work the land, if you're a labourer, a farm labourer, you work the land, you are entitled to then own it. You've mixed your efforts with the earth, therefore you should be allowed to own it. There was very little analysis of the initial distribution, as I mentioned, and land was actually conflated This rent problem land was conflated with capital in the theory of marginal productivity. The theory of marginal productivity essentially argues that for a business with a firm, taking on one additional labourer can increase the productivity of the firm if the firm hasn't reached sort of its full capacity in terms of productivity, or it could decrease it if that labourer, it raises the cost of the business without increasing productivity. So it's the marginal value of that each additional labourer determines wages, and in a sense, so how productive you are determines what you should be paid, basically, and income is essentially one's reward for one's contribution to production. Wealth, in contrast, is seen to be savings due to one's productive investment effort. The capitalist invests his capital, and that creates returns. He invests his capital, he makes money if the firm is productive, and those are his savings that he's created by his productive investment. So everything focuses around production, essentially. And capital and land are not seen as fundamentally different in the long run. An extra bit of land, helps you more or less according to how much more productive it makes your business. There's no fundamental difference in the long run. In the short run, there's some fixed costs because you have to build a house, etc. It takes longer than just employing someone, but in the long run, there's no fundamental difference. So land and capital become conflated. This is a slightly challenging, slightly technical argument, but chapter 3 of the book should explain it in more detail. But land is not the same as capital. It's actually very different, and this is the crux. This is the economic crux of the problem that we face. So land is inherently finite in supply. You can, of course, build houses, out in the countryside or in the middle of Scotland, in the Highlands, but actually nobody will want to live there, okay? Because it's nowhere near where people work. You'll be isolated. There's no services. There's no schools, etc., etc. People want to live where all those things exist. They want to be able to have a short trip to work. They want to have a decent school. They want to have nice cafes where they can drink nice lattes. They don't want to live in places where they can't access that stuff. So desirable location is inherently limited. And that's the opposite of capital, really. Capital is really constrained only by labour and energy, which is a real constraint, as we've seen with climate change. You can always create more stuff. Land is fixed and immobile. You can't move it around. Capital is highly mobile. Land appreciates in value with economic growth, as I've discussed, economic rents. Capital tends to depreciate. Machinery depreciates quite rapidly. Your mobile phone depreciates in value because of technological innovation. And as I said, ownership of land enables rent extraction. With capital, rentier profits are constrained by competition, depreciation, innovation. Obviously, you can get patents that can prevent that. And as I said, land has multiple conflicting uses. So anyway, these are not the same things. These are not the same things. They should not be conflated, but actually they were. And that's one of the real challenges with neoclassical economics. Now, land and finance. As I said, land's properties, the fact that it's finite, the fact that it's physically hard to move, it means it's hard to hide, and that it tends to go up in value, make it very attractive to banks as a source of security, a source of collateral for them to make loans. If a bank makes a loan to a small business, has limited liability, and the business goes bust, the bank's literally left with nothing. They have no way, they have nothing to claim back. But if you are unable to repay your mortgage, the bank can take your house. That's a key sort of fundamental difference, and that's what makes land so attractive. Now, prior to the 1980s, regulations actually limited normal banks' ability to issue mortgage debt, to make loans. Lending was limited to much more conservative building societies. In the US, you had savings and loans companies. These were often cooperatively owned, and you had to save with them for a number of years before you could get a mortgage. And they kept a very strict watch on how much savings you had versus how big the loan is that you were going to request. All of this changed in the 1980s in the UK and the US in particular. You had this deregulation of mortgage finance and financial innovations, in particular securitization, which I'll talk about later perhaps. And the research shows, the evidence shows that this was a key driver of land and house prices. And I won't go into that in too much detail, but here's the evidence. House prices and mortgage credit since 1870 in this chart. Again, this is averaged across, this time, 14 advanced economies. By the way, this is a very good data set on the internet, which contains brilliant historical macroeconomic data in case any of you are interested in this topic for your essays. But anyway, this shows, again, there's some sign of some sort of long-run equilibrium here up to about the 1960s, 70s in this case. Then you have real house prices, which is the right-hand axis, the blue line, starting to really increase, and accompanying it, you have this very rapid increase in mortgage credit, and it goes kind of really crazy again from the early 2000s onwards. So that's that question. I had it right at the beginning. How do we explain this rise from the 2000s onwards? Well, this mortgage credit seems to provide a good answer. And what banks actually do starts to change. This is credit stock to GDP, and you can see the orange line is mainly business lending, basically non-mortgage lending. That rises from about 20% of GDP to about 45% in 1990. Then it sort of levels off a bit, whereas mortgage credit overtakes business lending. So banks' traditional role that you read about in the textbooks, and we'll talk about this more in week 8 on money and monetary policy, but their traditional role of providing loans to businesses, they no longer do that. Actually, the majority of bank loans, and it's particularly the case in this country, where only about 10% of all bank loans support businesses for investment and for paying wages. That has fundamentally changed. Now, the argument that we make in the book, in both the books I mentioned actually, is that the deregulation of housing and the financial innovations that you've seen, particularly securitization, where banks essentially put together lots of different loans, package them up, loans of different risks, all mortgage loans but different risks, package them up and sell them on to other parts of the financial system, so typically to institutional investors, pension funds, insurance companies, and then take them off their balance sheet and get a fee in return for that. Financial deregulation innovation has increased the supply of mortgage credit at a faster rate than people's incomes and a faster rate than the growth of the economy, because there's nothing really stopping banks from creating money and credit to support house purchase, and people are competing with each other to get the most desirable property, and they're taking out these loans. The government could have pushed back against this. It could have said, no, house prices are getting too high. This is creating a bubble. We don't like this. But they did the opposite, especially in this country and in nearly all advanced economies. They did the opposite. They said, oh no, people can't, house prices are too high. People can't buy homes. Let's subsidize the cost of housing. Let's subsidize the cost of the mortgage with help to buy loans and subsidies to make the lending cheaper. Of course, it doesn't stop the quantity of money flowing into housing. It actually increases it. It makes it more attractive for banks and for property developers to keep pumping money into housing. So you get increased mortgage debt relative to incomes, increased land and house prices relative to incomes, and increased demand for mortgage debt. And this cycle feeds itself, and increasingly housing becomes a financialized asset. We expect house prices to go up. We know that they'll go up faster than our incomes or faster than other forms of savings, putting money in the stock market or whatever it might be. So we put more and more of our money into housing, and this further feeds into this cycle. You get speculative domestic demand, landlords, and also overseas investors, and house prices get higher and higher, and round we go. And the key point about bank credit is that bank credit involves money creation. Okay, it doesn't involve taking money from somewhere in the economy, pulling it out and putting it in somewhere else. It involves an expansion of the bank's balance sheet, creating an asset and a liability at the same time, creates new purchasing power. When a loan is repaid, that new purchasing power is destroyed. But if the rate of new lending is higher than the rate of paying off those mortgage debts, you will get a net increase in mortgage credit flowing into finite land. Right? Too much money chasing a limited supply of land will result in inflation. Everyone kind of agrees on this fundamental issue. And this shows the UK credit stocks, outstanding loans as a percentage of GDP, the left-hand scale, mapped against house prices on the right-hand scale, the blue line, and this even more marked, much more marked than the average, domestic mortgage credit in the red and business lending in the green. And again, this correlation between house prices and mortgage credit. Now, just to illustrate the point that how powerful this mechanism is, this chart shows two Eurozone countries, Ireland and Spain, which experienced basically the biggest housing bubbles of any country in the Eurozone in the run-up to the financial crisis. This is real house prices indexed to 1980. You can see both of them have this massive increase in house prices and a huge fall afterwards. What was happening to home building in these countries? Well, if you're a believer in that not enough homes are being built and that's the reason house prices are going up, you'd probably say they weren't building enough homes, were they? Wrong. They were building much more homes than anyone else in Europe, as this chart. I borrowed this chart from Toby, actually, so I have to credit him for this. But you can see there that Ireland and Spain are well ahead of the average. This is housing completions in 2007, running up to the financial crisis. Now, of course, what was going on was there was a massive credit bubble in both of these countries, huge amounts of credit pouring into homes. Banks can always create credit faster than new home completions. Now, why is this such a problem? Why have policymakers not done more about it? Well, part of the problem is that in Anglo-Saxon countries in particular, our entire economies have become dependent on mortgage debt. So there are two main channels, a mortgage down payment channel. As interest rates are lowered, people feel they can afford to take out loans to fund home improvement, to fund their holidays, to buy cars. They can actually use their houses as cash withdrawal machines, effectively. And the UK has a very deregulated home equity withdrawal channel. And as interest rates are lower, the real cost is lower. The sort of debt servicing ratio is kept low, even though the amount of debt is going up. And this just shows a UK GDP against home equity withdrawal. I'm going to hurry on. One argument against all of this is to say, well, okay, there's a lot more debt relative to incomes, but does that matter if the value of housing has also gone up, very rapidly? People's real wealth has increased, so yeah, they have more debt, but it's counterbalanced by the fact that their house is worth more. Well, actually, that's not the case, because if you look here, particularly at the UK, it's the worst example. This is the ratio of total household debt to the value of housing stock from 1980 compared to 2013. You can see it's almost tripled in the UK, and it's also larger in most other advanced economies. So actually, we do have a lot more private debt than we used to have, which is a problem I think Stephanie was alluding to in the last lecture. Inequality and wealth. Part of this problem is as housing becomes an increasingly big share of people's wealth, and it's not evenly distributed because affordability has meant a smaller and smaller number of people are able to own houses, particularly young people like you being shut out of the housing market. So inequality, wealth inequality, rises significantly. This is just property wealth as a percentage of GDP. This is net property wealth in the UK by decile, and you can see there increasing inequality over time. this is the basic fundamental challenge we face. If you're lucky enough to own a property, you see increases in your net wealth because your house price is going up faster than your debts, especially when interest rates are low. You enjoy greater economic security. You can borrow more because you can take out money from the value of your rising home to fund stuff. For everyone else, it just means higher rents, more money to save for a deposit, and less disposable income. At a more macroeconomic level, it basically means we are experiencing a sort of, financialization of the wider economy. This chart shows non-financial assets as a percentage of GDP in the UK. So it includes capital stock, machinery, the stuff, computers, the stuff that actually contributes to productivity of the economy. That's the red line. You can see that's remained basically flat since the mid-1990s at around 150% of GDP. You can see that housing has gone up, housing excluding the value of land, so that the physical domestic structures that we live in. It's gone up a bit, not massively, but you can see land has overtaken productive capital stock. Again, around about the early 2000s when you had this big expansion in credit and again maintained that higher. So, you say that we're becoming wealthier. Well, the main source of wealth is not productive, it's land. Land doesn't make the economy, just because the value of housing goes up, it doesn't make the economy more productive. It actually increased the cost structure of the economy. It means that businesses have to pay more money to rent property. We have to pay more money to live. We have less money for consumption, businesses less money for investment. Now, I think Toby will probably elaborate a bit on this historical picture, but just to try and sum up what I've been talking about on this economic rent problem in particular. Today, land rents, in this post-war period, the Keynesian era from the 40s onwards, government focused on subsidizing the supply side, on providing cheap public housing, buying up land and building housing. Land rents were to some extent taxed more. We had imputed rent, we had capital gains tax. If your house went up, you'd be taxed on it. As I said, mortgage finance was limited, and the source of growth was public and private investment in housing and rising wages. All of this has changed since the 1980s. Again, in Anglo-Saxon economies, we've switched to subsidising the demand for housing, subsidising mortgages, government giving people housing benefits rather than subsidising the supply. Tax has shifted away from property and on to income and consumption. We've had this massive expansion in mortgage credit. And growth is increasingly driven by debt-fueled private consumption, and much of it from home equity withdrawal, as I mentioned. I'm going to just leave you with this article. Was in the Observer, I think, just at the weekend on Sunday, about the privatisation of social housing, which I think Toby will probably touch on more. But this is a report showing that 40% of former council homes built in this period from the 1940s up to the 80s, many of them, are now rented out by private landlords. Okay, and so this is a quote from the London Labour Assembly member. Something has gone very wrong when tens of thousands of homes built to be let at social rents for the public good are now being rented at market rates for private profit, sometimes back to the very councils that were forced to sell them. So this is economic rent writ large across our economy. I'll wind up here to conclude. Land and housing have unique economic properties. They're not like other goods and services. They are very different, and you need to think about why that is. A deregulated land market will tend towards monopoly. If you just let people, let the market rip, those who already own property are in a much stronger position to buy up more property than those who don't. They've got the collateral, they've got more money, easier to get a loan from the bank, etc. Tend towards monopoly, rent extraction, and rising inequality. And a deregulated banking sector will tend towards real estate lending rather than business lending, because land is the most attractive form of collateral, also because you can make much bigger loans in general for mortgages than you can to, say, a small business. So the transaction costs for the banker are lower. And of course, these two things can interact and leave us where we are today. So the overarching lesson is policymakers need to shape the land market to optimize social welfare. And the alternative, of course, is we just leave it to chance and we play the game of Monopoly and hope that we're the winner. Thank you.